Ladies and gentlemen, welcome to FinTechs, the channel aimed at imparting basic knowledge on finance, economics, taxation, investment, and related topics. My name is G.V. Krishna Kumar, Chartered Accountant with more than 35 years of post qualification experience. In today's video, I'll be explaining to you about the ratios. Financial ratios are very important concept in finance. It helps in assessing the financial health of any company. The tagline of today's video is financial ratios for better decision making. The objective of today's video is to raise the level of financial awareness of the viewers and enable them to use the financial information provided to make better short term and long term decisions in managing their areas of operations. First, we will understand the meaning of ratio. Ratio is nothing but the term used to compare two or more numbers. It indicates how big or small a number is when compared to another. In other words, the ratio shows how many times one number contains another. For example, a classroom has got 60 students, out of that 20 are girls. Now, the ratio between the girls and the boys are 1 is to 2. For every 2 boys, there is 1 girl. This is how the ratios are arrived. Now, let us come to financial ratios. Financial ratios are created using numbers taken from financial statements to gain meaningful information about a company. The major main financial statements are balance sheet, income statement or profit and loss account, and cash flow statement. The financial ratios are derived by the numbers taken from the financial statements. The three basic or fundamental financial statements are balance sheet, profit and loss account or income statement, and third one is the cash flow statement. Normally, the numbers from the balance sheet and profit and loss account are used for arriving at the financial ratios. The balance sheet tells about assets, liabilities, and equity of the company, and the balance sheet is drawn on a particular day. Profit and loss account or income statement is about the revenue, expenses, and the resultant profit or loss of the company. Cash flow statement is about the actual inflows and outflow of funds into the company. Cash flow statement is further classified into cash flow from operating activities, cash flow from financing activities, and cash flow from investment activities. Profit and loss account is drawn for a period of time, that is for a month, quarter, half year, or year. Financial ratios are categorized into five different types based on what aspect of a company's financial performance they measure. They are profitability ratios, efficiency ratios, liquidity ratios, leverage ratios, and finally the market value ratios. The main purpose of calculating the financial ratios are to assess the financial health of the company. Apart from that, there are two purposes for which the financial ratios are calculated. The first one is track company's performance. Determining individual financial ratios for a period and tracking the change in their values over time is done to spot trends that may be developing in a company. For example, an increasing debt to asset ratio may indicate that a company is overburdened with debt and may eventually be facing default risk. Second one is make comparative judgments regarding company performance. Comparing financial ratios with that of major competitors is done to identify whether a company is performing better or worse than the industry average. For example, comparing the return on assets between companies helps an analyst or investor to determine which company is making the most efficient use of its asset. The main users of financial ratios are financial analysts, retail investors, creditors, competitors, industry observers, etc. Profitability ratios explains how efficiently a business is run and how the company is making profit compared to other similar companies. Profitability ratios measure companies' ability to generate income relative to revenue, assets, operating costs, and equity. Common profitability financial ratios include the following: the gross margin ratio. The gross margin ratio compares the gross profit of a company to its net sales to show how much profit company makes after paying its cost of goods. The operating margin ratio compares the operating income of a company to its net sales to determine operating efficiency. The return on assets ratio measures how efficiently a company is using its assets to generate profit. The return on equity ratio measures how efficiently a company is using its equity to generate profit. Efficiency ratios. Efficiency ratios, also known as activity financial ratios, measures how well a company utilizes its assets and resources. Common efficiency ratios include the asset turnover ratio, which measures company's ability to generate sales from its asset. The asset turnover ratio is calculated by dividing the net sales by its total asset. The inventory turnover ratio measures how many times a company's inventory is sold and replaced over a given period of time. Inventory turnover ratio is calculated dividing the cost of goods sold by the average inventory held by the company. The accounts receivable turnover ratio measures how many times a company can turn receivables into cash over a given period. Receivable turnover ratio is calculated by credit sales divided by average accounts receivables. The days sales inventory measures the average number of days that a company holds on to inventory before selling it to customers. Days sale inventory ratio is equal to 365 days divided by inventory turnover ratio. Third most important financial ratio is liquidity ratio. Liquidity ratios measure a company's ability to pay both short and long term obligations. Common liquidity ratios include the following: current ratio. Current ratio measures a company's ability to pay off short term liabilities with current asset. Current ratio is calculated dividing current assets by current liabilities. Current ratio above 1.3 is seen as a better ratio. Below 1.3 is seen as company has got liquidity issues. Quick ratio measures a company's ability to pay off short-term liabilities with quick asset. What are all the quick assets? Quick assets are current assets minus inventory. Therefore, quick assets are cash and cash equivalent and receivables. Quick assets divided by current liabilities is known as quick ratio. Quick ratio around 1 is better. Cash ratio. Cash ratio measures cash and cash equivalent in relation to current liabilities. How much cash and cash equivalents are there in relation to current liabilities? Higher the cash ratio, it is better for the company. Leverage financial ratios. Leverage ratios measures the amount of capital that comes from debt. In other words, leverage financial ratios evaluate a company's debt levels. Common leverage ratios include the following. The debt ratio measures the relative amount of company's assets that are provided from debt. Debt ratio is equal to total liabilities divided by total asset. The debt equity ratio calculates the weight of total debt and financial liabilities against shareholders' equity. Debt to equity ratio is equal to total liabilities divided by shareholders' equity. The interest coverage ratio shows how easily a company can pay its interest expenses. Coverage ratio is equal to operating income divided by interest expenses. The debt service coverage ratio reveals how easily a company can pay its debt obligation. Debt service coverage ratio is equal to operating income divided by total debt service. Market value ratios are very important ratios. Market value ratios are used to evaluate the share price of a company. Common market value ratios include the following. Earning per share or EPS. EPS measures the amount of net income earned per share of the company. The higher the EPS, the better. Earning per share is equal to profit after tax or net income divided by number of equity shares. Price to earning or PE ratio compares a company's share price to its earnings per share. PE ratio is equal to market value per share divided by earning per share. Dividend yield. The dividend yield ratio measures the amount of dividends attributed to shareholders relative to the market value per share. Dividend yield ratio is equal to dividend per share divided by market value per share. Higher the dividend yield, it is better. Book value per share. This ratio calculates the per share value of a company based on the equity available to shareholders. Book value per share is equal to shareholders fund divided by number of equity shares or net asset value divided by number of equity shares. Hope this video was informative and useful to you. If you like the video, please share it with your friends and associates. If you have not yet subscribed to my channel, kindly subscribe. I will be coming with more and more videos of this kind. Thank you, thank you, thank you for watching.